Hello learners, this is Jyoti Mandral. I am an assistant professor in Department of Management Studies at Uttarakhand Open University. In today's lecture, we are going to study about primary market. Firstly, let's see the content of today's lecture. Firstly, we will start with the introduction. After introduction, we will cover the working of primary market. After that, primary market functions, and then instruments of primary market. After that, types of primary market issuance. So firstly, let's start with the introduction. So financial market. So the financial system also includes financial markets as a component. This is a system that moves money or savings from units with surpluses to units with deficits. Financial services and financial securities, often known as financial instruments, are traded on the financial market. These markets fall into capital market and money market. Capital market deals with those financial assets having maturity period more than 1 year. Money market deals with financial assets having maturity period of less than 1 year. So as we know, primary market, it is a part of financial market, and I have told you what is financial market. So basically financial market is a market where the people who are having surplus funds, they lend that fund to the borrowers, means the people who are in need of that fund. So primary market, it is a part of financial market. So it was important to firstly have an overview of financial market. So now as you know what is financial market, so let's move ahead to the primary market. The primary market, often regarded to as the new issue market, is the market where businesses or governments establish and issue securities for the first time in order to raise money. So basically in primary market, the securities are going to be issued for the very first time in order to raise money. So examples of these securities include stocks, primary bonds and debentures. The market where new securities are purchased and traded for the first is referred to as the main market in the finance industry. Companies or governments offer these securities directly to investors in the primary market where they are bought for the first time. The primary market is crucial to the economy because it gives investors the chance to purchase new securities and gives government and businesses a means to rising capital. So basically it is a this primary market, it is a bridge between the people who want funds and the people who are having fund in surpluses. Because of this primary market, the people who are having funds and surpluses, they can lend the fund to the people who are in need of that fund. So primary market, it is a bridge between both the parties. Now let's understand the working of primary market. As an essential part of the financial system, the primary market makes it easier for new securities to be issued and sold to investors. For businesses and governments looking for money for things like expansion, research and development or debt repayment, it is crucial in supplying necessary capital. So financial market, so primary market, it is a very important part of financial market. It helps the people or it helps the government. For example, if the businesses or the government, they want money for expansion. If a business is there and the business want to expand its area or business, then it can raise the capital from the primary market. Similarly, for the research and development purpose, again for the research and development purpose, the firms or the government, they need funds, so they can raise the fund with the help of the primary market. So essentially the primary market serves as a channel for money to be transferred from investors to companies, giving them the resources they need to expand and succeed. This market is separated into two sections. The first one is the primary market, where securities are sold directly to high net worth individuals or institutional investors, and the second one is public market, where securities are made available to the general public through an initial public offering. So here again in primary market, it is again divided into two sections. The first one, that is a private market, where the securities are directly issued to the private institutions, and the second one, that is public market, or where in the public market everybody, means the general public, they will get a chance to buy the securities. So with the help of a initial public offering, IPO, in the primary market, in the primary market they issue the securities to the general public with the help of the IPO. Now let's see how this primary market works, or we can see the functions of primary market. In the economy, the primary market serves a number of crucial purposes. Let's understand these functions. A few of the primary market goals are as follows. The first one, that is obtaining funds. For businesses wishing to grow, engage in new ventures, or settle debt, the primary market is an essential source of funding. Businesses can raise the money they require to expand by issuing new securities in the new issue market. So basically the primary or the main function of primary market, that is obtaining funds. So the businesses or the governments, they can obtain funds with the help of primary market. The government or the institutions, they can issue their securities, and the people, those who are having surplus money, they will buy those securities, and on behalf of those securities they will buy the securities, and on the other hand the surplus fund, it will go to the institutions or the government, and with the help of this fund they can expand their business. Now the second function of primary market, that is finding prices. By determining the initial price through the IPO or other methods, the new issue market aids in determining the fair market value of recently issued securities. By using this procedure, investors can make sure they are purchasing shares at a reasonable price. The next function, that is encouraging the transfer of risk. The risk is passed from the business to the investors who buy the recently issued securities in the main market. By doing this, businesses can lower their financial risk and pass it along to investors who are prepared to assume that risk in return for the possibility of larger profits. Now, as we have covered the functions of primary market, now next we will study the instruments of primary market. Means what are the instruments or what are the securities which can be issued in the primary market. So the first security or the first instrument of primary market is equity shares. In the major stock market, these are the most prevalent new market security vulnerabilities. In addition to gaining shareholders' voting rights and a portion of the company's income, equity shares also symbolizes ownership in the business. So if a person will buy the equity shares along with the voting rights that shareholder he will also get, or he will also get a ownership in the business, because equity shareholders, they have the voting rights, they can participate in the major decision making. The second type of instrument of primary market, that is debentures. A business may issue these bonds in order to raise money. Debentures have a maturity date when the business repays the principal and pay a fixed interest rate. A corporation also selects underwriters to rate its debentures. Now the third instrument of primary market, that is bonds. These bonds, which are issued by corporations or governments, resemble debentures. Bonds have a set maturity date when the principal is paid back, and they also pay interest to investors. So if a person is buying the bonds of any company, they will also get interest on behalf of that. Now the next one, that is right issue. When a business gives current shareholders the option to buy more stock at a reduced price, this is known as right fresh issue. The third one, that is IPO. An IPO is when a business issues equity shares to the general public for the first time. An IPO is usually used by businesses to raise money for business expansion. So the main motive of IPO, initial public offering, is to raise money for the expansion of the business. The next one is FPO. An FPO is when a company issues additional equity shares to the public after an IPO. Companies use FPOs to raise additional capital for business expansion or to pay off debt. Now, as we have studied or the securities or the instruments of primary market, now the next thing which we are going to cover, that is types of primary market issuance. Investors can purchase securities through a variety of avenues once they are issued. There are 5 main categories of market issues. The first one, that is public issue. This popular approach is a business selling securities to the general public, usually via an IPO, that is initial public offering, with the securities listed for trade on stock exchanges. This enables businesses to raise money from the capital market. A privately held firm becomes publicly traded through the initial public offerings, that is IPO process, which makes it easier to raise money for debt repayment and expansion. The next one, that is preferential problem. Preferential offerings, which involve businesses providing shares or convertible securities, convertible instruments to a certain investor groups, are a rapid way to raise funds. Preference shareholders get dividends ahead of common shareholders. So basically the preference shareholders, they will get preference. That's why in their name only preference is mentioned. So they will get preference in terms of the dividend. They will get dividend ahead of the common shareholders. Now the next one, that is placement in private. A limited number of investors, including both individuals and institutions, may be offered securities by companies. Compared to initial public offering, that is IPOs, private placements, which include stocks and bonds, are less regulated and provide simplicity and cost effectiveness. This approach works well for startups or early stage businesses. So if any startup is there or a new firm is there, they can go for the placement in private, that is private placement. So in private placement, they don't have to offer IPOs. They can skip this IPO. They can directly give their securities or investments to the people in privately. So it will save their time also, and it is a better approach for the early stage businesses because it is very less regulated. Now the next one, that is placement in qualified institutions, that is QIP. So qualified institutional buyers are the recipients of securities issued by the listed corporations through a private placement known as qualified institutions. Financially savvy QIBs include organizations such as insurers, mutual funds, and foreign institutional investors. Compared to preferential allotments, QIP's procedures are easier and less time taking. So if this process, that is placement in qualified institutions, it is much easier because as in the name only qualified institutions is there. So only the people who have qualified, who are having good name in the market, who have a brand value, they will only get the securities. Now the next one, that is rights and bonus concerns. In right offerings, current investors can increase their power without incurring new expenses by buying more stocks at a set price. Bonus offerings do not add new capital, but they do involve giving away free shares to current shareholders. So here this bonus concerns, in this bonus concern, as we all know what is bonus means something that is an additional. So in this bonus shares, they involve giving free shares to the current shareholders, means the people who are already the shareholders of the company, they will get some extra shares as a bonus. So this bonus shares, it will not add to the capital of the company. This is not going to increase the capital. It just means that the already the existing shareholders, they will get some shares as a bonus. So in this lecture we have covered the introduction of primary market. As primary market, it is a part of financial market, so it was important to know what is financial market. So firstly we have studied the what is financial market. After covering the financial market, we came to the primary market. Primary market, it is a part of financial market. After seeing what does primary market means, we have studied the working of primary market, which means that how this primary market works. After seeing this, we have studied the various functions of primary market, which includes obtaining funds, as when any organization or government, they need funds, they can go to the primary market. They can raise capital with the help of primary market. So primary market, it is a bridge between the people who are having funds in surplus, known as investors, and the people who need funds, that is borrowers. So after covering the functions, we have studied the various instruments of the primary market, which means which are the various ways which securities can be issued in the primary market. And after studying this, we have studied the primary market issuance. So that's all for this lecture. The next there are some other important things in the primary market which we will cover in the next lecture. Thank you.